Meta stock has gone from $60 to over $430 in the last 10 years. That's a 7x return, and it's up almost 80% in the last year. It dominates social media with 3.24 billion daily active users, has a market cap over $1 trillion, and is making a massive push into augmented and virtual reality as well as AI. So is now the time to buy this social media superstar? Tune in and find out. Okay, there are 3 points that this video is going to cover. Number one, the business model. So there's 2 pieces: advertising via the family of apps, and Reality Labs, which is the company's push into augmented and virtual reality. Number 2, AI and the future. In the 1Q earnings call, Mark Zuckerberg talked about the company's AI and metaverse efforts, and I've highlighted the most important points for you. And lastly, the valuation. Wall Street has Meta at an average of $525, which is an 18% discount. On Wall Street, we build 3-statement financial models culminating in a DCF valuation. I have built a 3-statement model and think that Meta is at a discount at current levels, and I can't wait to give you all the details. So let's dive right in. Okay, part 1 of this video, the business model. So 2 key components: advertising and Reality Labs. Probably should send my ex-girlfriends there. All kidding aside, advertising is about 98% of the business. It's remained steady for the last 5 years. It has a 5-year growth of 2.4x. It's $132 billion of 2023 revenues, and this consists of advertising on Facebook and Instagram. Number 2 is Reality Labs. It was non-existent 5 years ago. Over the last 4 years, it's had 3.8x growth. It's only a small portion of the business, $2 billion in revenues. This consists of augmented reality. Think of like the Ray-Ban Meta smart glasses, which have a conversational AI assistant and live stream video, as well as virtual reality via MetaQuest devices for gaming, fitness, and entertainment. Now, the family of apps have almost 50% margin, but Reality Labs lost $16.1 billion last year, and that loss will continue to grow over time. So what's the takeaway? Advertising and the family of apps are the main driver of the current business, but augmented and virtual reality and the devices that deliver that are the future. Okay, part number 2 of our video, the future. So Mark Zuckerberg in the 1Q earnings call covered 5 different points, which I'm going to dive right into. Number 1, the family of apps. We're talking about Facebook, Instagram, Messenger, Threads, and WhatsApp. There are more than 3.2 billion people who use at least one of those apps daily. WhatsApp is gaining number of daily actives and message sends in the US. Instagram Reels are now making up 50% of the time that's spent on the app, and Threads is growing really rapidly with 150 million monthly active users. Number 2, AI. Meta AI is an AI assistant that you can ask questions across all apps and even the VR glasses that they have. Meta AI is powered by their latest model, Llama 3. And Meta AI, according to Mark Zuckerberg, is the most intelligent AI assistant, making it easier to use WhatsApp, Messenger, Instagram, and Facebook. Now, the goal is to build the world's leading AI service, both in quality and usage. The initial rollout of Meta AI is going well. Tens of millions of people have already tried it. They also have creator AIs that help creators engage their communities and that fans can interact with, as well as business AI that helps customers buy things and get customer support. Now, very important, Meta product development playbook. As Mark Zuckerberg mentioned, they release an early version to a limited audience, they gather feedback, and then they improve it, and then they release it to more people. Now, number 3, he gave a very stark warning. They're shifting most of their existing resources to focus on AI, and there's a lot of investment required, so it's going to take time to realize revenue. They've historically seen a lot of volatility in the stock during this phase. Now, Reality Labs last year lost over $16 billion, and he said that that loss will continue to grow over time. But the silver lining is we saw this with Real Stories and the news feed when it transitioned to mobile, and he said he expects multi-year investment in this cycle until they've fully scaled Meta AI. Number 4, AI progress. About 30% of posts on Facebook feed are delivered by the AI recommendation system, and that's up over 2x over the last couple of years. More than 50% of the content that people see is now AI recommended. Also, really interesting, they're making their own chips, and they're going to be less expensive than the types of chips that they get from NVIDIA and others. Lastly, number 5, Reality Labs. So what they're looking to do is build out all of their VR and AR, virtual reality and augmented reality devices for fitness, entertainment, and gaming. They already have the Ray-Ban Meta glasses that they've built with Luxottica, and they're continuing to do well. They're sold out in many different styles. Now, he looks at this as a really key piece because wearable AI eyewear is a little bit different from phones and watches. You're going to own multiple pairs of glasses, but one phone and one watch. So he really sees a lot of potential with that product. So what's the takeaway? The family of apps is the income driver. AI is a major focus. It's being tested through physical devices and the social media apps, and the company's making its own chips. But here's the key. Plan on investing for multiple years until revenue is realized from AI and AR and VR devices. So there's a lot more investment that has to go into those devices. If you're enjoying this, please smash that like button. All right, getting into the valuation portion, part 3 of our video, we start out with the balance sheet. So the company has tons of cash, almost $60 billion. They've averaged $50 billion of cash over the last 7 years. They only took on debt starting in 2022. They've been self-financed up to that point. They're still net cash, meaning cash is greater than debt by $50 billion. Retained earnings has doubled in the last 5 years, and despite buying back $100 billion worth of shares from shareholders, they're also investing heavily in AI and Reality Labs VR, which we will see next in the income statement. So what's the takeaway? They're very conservatively financed. They're net cash. They have a solid balance sheet with a AA- credit rating. Let's hop in the model. All right, so as we can see, tons of cash that the company has. They only took on debt in the last couple of years. They've had massive growth in retained earnings. So everything is looking very, very good for the company from a balance sheet perspective. Next, we have the income statement. So revenue has grown 2.4x in the last 5 years. Remember, the company has over $135 billion in revenues. They have big investments in AI and Reality Labs, $130 billion over the last 5 years and $38 billion last year. They're reinvesting in the business, returning capital to shareholders. We're going to see this next in the cash flow statement. Gross margin is about 90%. Remember, advertising is a service, not a product, and net margin is 30%. So this is a very high margin business. Also, they're net interest positive, which means interest income is greater than interest expense by about $1.2 billion. So what's the takeaway? The company is growing rapidly with a 5-year average revenue growth of 20%. They're investing heavily in R&D. They have a 5-year return on invested capital of 24% and a 5-year ROE of 25%. These are sky-high returns for a $1 trillion market cap company. Let's dive in the model. Okay, so what do we see? Massive revenue growth over the last several years, 2.4x over the last 5. Research and development, a massive increase in R&D, $130 billion over the last 5 years. They are net interest positive, meaning interest income outpaces interest expense, and they've had a massive and significant growth in net income. All phenomenal things that we like to see on a company's income statement. All right, next we have the cash flow statement. Free cash flow has tripled in the last 5 years, while operating cash flow has more than doubled. Now, the company recently announced a dividend. It's going to end up being about $5 billion in 2024, but they've been returning capital to shareholders, $103 billion over the last 5 years, and they're reinvesting in the business. CapEx was $108 billion over the last 5 years. It's going to be $214 billion over the next 5 years. They're also making tons of money off of their cash. With $107 billion of positive cash flow over the last 5 years, this is what they're using to buy back shares, not their net income. So what's the takeaway? Cash is going to 4x by 2028 if the 5-year trend continues. They're projected to invest $214 billion in CapEx over the next 5 years. If you're finding this helpful, please hit that like button. Let's hop in the model. Okay, so massive increase in free cash flow. As I mentioned, they're basically buying back shares from the money that they're investing with their cash. Also, the share repurchases have been very significant. Remember, they are going to have a dividend on a going forward basis. But despite that, they've still returned $103 billion to shareholders over the last 5 years. Lastly, their cash balance is scheduled to increase 4x over the next 5 years. Truly remarkable. All right, so next we have forecast drivers and DCF assumptions. So the savings that they've received from their SG&A has been plowed into R&D. Despite that, they've still shaved 2% off of their cost structure, which is about $3 billion in savings. Now, their research and development is above tech peers, with approximately 28% of revenues being plowed into that. How are they doing that? They're investing in innovation via Reality Labs, which is AI and VR. They have very high CapEx, over 20% of revenues. They're reinvesting in the business. Now, they have a moderate beta for a tech firm, 1.2, a moderate WACC of 9.6%. They have low leverage, 1.7%, and a AA- credit rating. So what's the takeaway? Conservative assumptions are going to give us conservative results. Let's hop in the model. All right, so 20% average revenue growth over the last 5 years. You can see the massive ramp up in R&D, but the good news is that's come from the savings that they've had in SG&A, sales and marketing, general administrative. You can also see their CapEx over 20% of revenues. Pretty remarkable, a very, very high amount. Okay, so next we come to our DCF assumptions. We have a risk-free rate 5-year of 4.72, 1.2 on the beta, 4.13 on the equity market risk premium. We get a 9.7 cost of equity. They have a very high credit rating, so their pre-tax cost of debt is only 5.4%, post-tax about 4.3%, low leverage less than 2%. We end up getting a WACC of 9.6%. Now, a few things to note here. Cash, pretty massive. They have $32.3 billion in cash and cash equivalents, 25.8 in marketable securities. And then lastly, the company has a terminal EBITDA multiple of 15x. It's currently 14.9. It's ranged as high as 19. I think this is still a fairly conservative assumption. Remember, this is what we're going to multiply the terminal EBITDA by to get the value from the end of the model out into infinity. All right, next we have our DCF valuation. We ran 3 scenarios, a bear, base, and bull case with the current model at base. This company has high growth, lots of cash, big investments, and a push into AI. But is it worth buying today? Remember, the stock is up almost 80% over the last year. So what's the takeaway? Wall Street has Meta at an average of $525 per share. It's an 18% discount. To see what we get, let's hop in the model. All right, standard DCF valuation. We have EBITDA less DNA gives us EBIT. Strip out the cash taxes. We get EBIT or NOPAT. We add back the DNA. We strip out operating working capital and CapEx to get free cash flow to the firm. We end up also calculating our terminal value, which is 15 times the terminal EBITDA, to get the cash flows to discount. We multiply those by the discount factors to get the present value or the time value of money values for those future cash flows. That results in a TEV of about $1.1 trillion. We have to strip out debt, add cash, strip out non-controlling interest, and add associate investments. What we see here is we get an implied share price of about $455 per share, which at the current level of $430 per share gives us a discount of about 6%, which is a hold rating. Remember, on Wall Street, we want greater than 20% discount in order to be willing to buy. Between 0 and 20% discount, that's a hold. All right, next we have our sensitivity and scenario analysis. So we ran 50 different models by utilizing data tables. We sensitized revenue growth and CapEx intensity, as well as WACC and terminal multiple. 13 out of 50 or 26% showed sell, 35 out of 50 or 70% showed hold, 2 out of 50 or 4% showed buy. We ran each of the 3 scenarios equally weighted, and we got a weighted average value of $460 per share. That's a 7% discount. So utilizing conservative assumptions, we show a discount, but it is a hold rating for the stock. So it's at a discount, but it's not cheap. Let's hop in the model. All right, so we have our sensitivity analysis. We ran 2 different data tables, CapEx intensity and revenue growth, WACC and terminal multiple. Again, we get 26% sell, 70% hold, 4% buy, so it's a majority hold. Okay, last but certainly not least, we have our scenario analysis. So we ran the bear, base, and bull cases. We equally weighted each of them, and we ended up getting a sell in the bear case, a hold in the base case, and a buy in the bull case. The net result is about $460 per share, which is almost a 7% discount. So this is a solid hold. It's at a discount, but it's not necessarily worth buying today. All right, so here's the wrap. Wall Street has Meta at an average of 525, which is an 18% discount, a high of 593, which is 27% discount, a low of 400, which means it's 8% overvalued. Our analysis showed Meta at a value of around 455, 460, which is about a 6 to 7% discount. Now, you should always seek the advice of an investment professional. I personally do not have a position at Meta at the current point. It was below $400 back in early February. I'm looking for the high 300s. The valuation's at a slight discount, and considering the long investment runway, I'd be on the lookout for pullbacks if you want the only social media stock out there. Meta is a social media juggernaut with almost $60 billion in cash, very little debt, a AA- credit rating, and over $200 billion of CapEx allocated for virtual reality and AI, and I'm excited to see what they do. Now, if you like this and you want to see another tech valuation, check out my Alphabet or Google model right here, or my Amazon model right here. And if you found this valuable, please share this with someone that you think would enjoy this. And as always, be relentless.